And we're going to cover a few ideas tonight that are going to have a high impact on everyone's wealth plan. So we're scheduled here for an hour, and I want to be conscious of everyone's time. So we're going to be moving a little bit quick tonight, but don't worry, we're going to give everyone options to have some additional resources before we hop off tonight. I'll stick around afterwards and answer any questions anyone might have. But with that, let's jump into one of our core ideas and philosophies here at Factum, which is the perfect life is having abundance in all 5 areas of life. So if you're new to our Factum community, welcome. And this is an idea that you're going to see integrated throughout all of our education, a lot of the frameworks we build around wealth building. And what we believe is when you have abundance spiritually, personal, in your family life, financially, and with your occupation, that's when you're waking up and every second of every day, you are living life to its max potential. And I think when you focus on this as your primary objective in life, this is a life you'd never want to retire from. And we're going to spend a few minutes tonight, about 60 minutes tonight, talking about the financial area of life and how to win in that area. But the only reason that I get excited about teaching people how to win financially is so that you can go out and fund the other missions of your life. That's the purpose of winning financially. So with that, let's jump right into this, and we're going to talk about something called the tough money effect tonight. Now, the reality is your ability to thrive over time, not if, but when events happen, is going to be dictated by how tough is your money. And what do I mean by an event? An event could be a lot of things. It could be a death, a divorce, an accident, a lawsuit, a recession, a change in taxation. Events can take many forms in our life. And if we don't have tough money, this quick visual is what you're experiencing financially. Every time there's an event, we feel like we're taking steps backwards financially. But if your money is set up properly, you understand the path of money, the proper sequence of how to build wealth. When events happen, not if, when, you can be in a position to actually thrive financially. And I'll tell you a quick story. In 2008, I had watched my parents do everything right for the last 10 years. So 1998 through 2008, I watched my parents do everything right, running a business, raising 11 kids. So I'm the second oldest of 11 kids. I got a very large family. And my parents did everything right. And when 2008 rolled around, they were investing in some real estate. And the leverage potential there was unbelievable. It was supposed to retire my parents. But that one event really crippled our family financially for the next 10 years. It wiped out my parents for almost 10 years. And what's interesting about that is families that I went to church with, grew up with, in the same communities, similar wealth levels, if you will, they survived 2008. And when real estate went on sale in 2010, 11, and 12, the same families that went through 2008 that survived were able to buy real estate at prices we may not ever see again. It was an event that literally created fortunes for families. And this same event provided 2 completely different situations. So we're going to talk a little bit about this tonight and how we can just get tougher with our money. Now, the tough money experience tonight, we're going to cover 3 main ideas. Idea number 1, we call the inconvenient truth. And the question you need to be asking yourself tonight is how or why do my habits affect my wealth plan? The inconvenient truth is no one's coming to save us. There is no financial advisor. There is no fiduciary coming in to save the day. If we don't take control of our own money, nobody else, I can promise you, cares about your financial situation more than you do. We have to just get closer to our money, and it's going to require some change of behavior. Idea number 2 we're going to talk about, which is the problem. And this is a banking problem. And the question you should be asking yourself tonight is, how does banking affect my wealth plan? We're going to talk a little bit about that. And then we're going to end with idea number 3, which we call the toughest asset. What is the foundation of my wealth plan? Are there assets out there that can give you an unbelievable advantage to keep your money so tough that you will be able to thrive through any environment? So with that, let's dive right in and let's get orientated to one of our most common and popular frameworks we teach here at Factum, which is what we call the path of money. Now, full disclosure, this was inspired by billionaire Gary Keller, who owns the largest real estate company in the world. We got this model from him. And basically, all of us are working for money. And as money flows into our life, it goes into what's called an income statement. And then as money flows through our life, there's really only four things we can do with it. We can spend it, we can donate it. The rest is called savings. And as soon as we start saving money and then investing, which is the fourth thing you can do, that's when we actually start building what's called net worth, and we own things in our financial world, and we call that your balance sheet. So really simply, you could teach this to your 15-year-old on the back of a napkin about how money works in their life. You could teach this to your board of directors if you were running a multi-million-dollar business. And the simplicity of this model has been so effective for so many of our agents and our clients learning about how to be more effective with their path of money. And all of the clues that you need to progress financially after tonight's call are actually sitting right on this Path of Money page. Now, where we focus as a company, a lot of people think, oh, I'm coming to one of these classes because they're going to teach me about investing. Everyone wants to go to the investing seminar. We are a company that specializes right here in this green box, the liquidity or the hold category. This is your wealth foundation. Most people do not have a thoughtful framework on where they save and hold cash or cash equivalents. And I'm going to show you some strategies tonight that are going to be so exciting and so game-changing for your financial plan. You'll never be able to look at money the same way ever again. So when we talk about this path of money, there's a few clues that you need to understand, and it'll tell you exactly what the next best moves you can make to increase your financial situation. The first thing you got to understand is, what is your current income? In this case, we're going to be monitoring a family that makes $150,000 a year. We call this the top 10% income earning family. And they have $50,000 of what's called liquidity in their foundation or their hold category. That could be money, actual cash. It could be a checking account, savings account. This could be life insurance, cash values. All of those are liquid, safe assets. You would not put anything in this category that's home equity, retirement accounts, anything in the stock market. That would all exist in the invested category or the acceleration piece of your wealth plan. So this family has $50,000 of cash reserves. They have $790,000 of investment equity, whatever that may be, real estate, stocks, whatever that is. So their net worth is a combination of everything you own, how much liquid wealth and how much invested wealth, for a total of $840,000. So this family has an $840,000 net worth, okay? And we're going to give everyone an opportunity at the end of the call to book what's called Path of Money analysis. Now we're going to jump headfirst into idea number one, the inconvenient truth. Why do my habits affect my wealth plan? Let's talk about that now. So the most accurate way to describe like where you're at in the money game is called net worth. And there are levels to the money game. Can we agree on that tonight on the call? There are different levels. Like there are things billionaires do, think, and how they behave that are just different. If you're in a level one category and they're worth, $2.5 billion, there are levels to this game. And wherever you're at on the scale, it does not matter. But you want to think of this exercise like a GPS. If you want to use a GPS, the purpose of a GPS is to get you from point A to point B in less time with less risk. So you need to know your starting location and you need to know the destination of where you want to arrive. Now, if we were to categorize your net worth into levels, if you're anything under 100,000, we call that level one. If you're between 100,000 and $1 million, we call that level two. If you're between 1 million and 10 million, that's level three. And anything over $10 million, we would call level four. Now, depending on where you're at in this money game, in this case, if this top 10 American income earning family we're tracking has a current net worth of $840,000, we'd classify them as a level two individual. Now, when they come to a class like this, they know where they're at, and they say, Kyle, I'd love to go to a target net worth of $3 million. If I could go from 840 to owning enough assets that I'm worth $3 million, that would produce enough passive income to fund the life I've always wanted. So, starting location, destination. Now, we also know this family has $50,000 of liquid net worth. Now, there's a huge clue right now that their liquidity position, something is off with their path of money. Their hold category is not following or trailing their net worth. And it's actually too large of a spread. It's going to be very difficult for this family to accomplish what they're trying to accomplish without having a tougher foundation. Now, a lot of you probably think about this is probably what's going on in your head when you come to a class like this and you say, of course, I want to go from 840 to a $3 million net worth. And the question is, well, what's my next move? And inside your head, this is probably what you're experiencing. What do I even focus on? Do I go hire a tax strategist? Do I get my home and auto insurance set up properly? Do I start investing? Should I buy whole life insurance? Do I do infinite banking? Do I get my trust structure going? There's so many things you can be focused on. And we call this the junk drawer. You kind of reach in the junk drawer and you pull something out and you say, yes, I'll focus on this. And this is why a lot of people like naturally get to a certain point in the money game. And then they're like, I have no idea what I'm doing now. And the phrase that we've been using with this is what got you here will not get you there. And what we've done with our Tough Money curriculum is we've taken all of those elements and we've sequenced them properly based off of your income, your net worth, and your liquidity. All of those are clues as to what are the primary things you should be focused on at each level to not only get through the level faster, but to stay in that level and to do it in less time and less risk. So there are certain things you want to focus on at the right time. And if your sequence is off, you're going to feel this. You're going to feel like you're spinning your tires in the financial game. So let's talk about income levels real quick. One of the things that are all over the country, we get to teach this stuff all over the country at this point. And one of the things I always hear is, yeah, that's great, Kyle, but if I could just make more money, that would solve all of my financial problems. Now, I'm always in favor of creating more money. I think living in the United States offers us an unbelievable advantage and opportunity to create income. But I'm going to go ahead and say that income is not necessarily our problem in this country. Feel free to unmute yourself or throw it in the chat. What do you think you need to be bringing in as a U.S. household to be in the top 50% of income earning families in the U.S.? So if we took a household and they make X amount of dollars, you make more money than 50% of Americans if you bring in this much. What do you all think that number is tonight? 25,000, 250. I love it. We already have a wide range here. Take a look. $50,000. If you make $50,000, you make more money than half of the American households. If you bring in $99,000, you're in the top 25% of income earning families. If you make a little over $170,000, you're in the top 10% income earning family. $260,000 will put you in the top 5%. What do you all think you need to be making annually as a household to be making more money than 99% of Americans? I see a 6. I'm assuming that's a 600,000, Michael. We have 350 in the chat. Any other guesses? 500. I love it. The answer is 663. It actually was about 515 about a year ago. These have increased since then. Now, the reason I'm showing you this is perspective. Bonus question. What do you think you need to be bringing in worldwide to be the top 1% of income earners if we took the U.S. and averaged every other country in the entire world? Keep in mind, we are very blessed with uncommonly high incomes in the United States. Top 1% income worldwide, what do you all think that number is? $175. Any other guesses? 100? Let's take a look. $34,000. If you make $34,000, you make top 1% income in the entire world. So the perspective I want you to leave with today is if you're making $50,000, $60,000, pat yourself on the back. You have an uncommonly high income compared to the other parts of the world. Sometimes it may not feel like that, but the reality is you have an uncommonly high income where you're living right now. And so maybe, just maybe, income is not necessarily the problem that's been keeping us from becoming wealthier. I think it's one of the greatest levers that you can work on to go create more opportunity and make more money. Let me tell you where the problem actually resides. It's how much of that income are we actually keeping and saving? Average savings rates have been hovering, staying right around 5% for as long as we can track this. 5% or less is the average savings rate. Actually, as of April of 2026, the personal savings rate is down to 2.6%. One of the wealthiest countries, if not the wealthiest country in the world, and we're keeping less than 5% of that income on our balance sheet. Money's coming in, it's going right out. This is why behaviors and habits around money matter more than anything. So one of the clues to be getting tough with our money is you got to become an uncommonly high saver. That means you got to start saving at least 10% minimum, or get as close to 30, get as high as you possibly can with your savings rate. That will condense all the other time frames that you're trying to achieve if you're looking to build, passive income or start investing. The earlier and more aggressively you can be saving money puts you in a position to do those things. All right, the low savings rate bleeds into a secondary problem. It's how much cash are we holding on average? Now, this is a study that JP Morgan Chase Institute did with studying 600,000 business owners. And I'm out here in the Phoenix area. You can find where you're at in the country. Average days of liquidity or cash reserves is less than 30 days. So if you were to ask most Americans, do you ever feel financial pressure? The answer would be every single day of my life. And the reason is we're not saving enough as a percentage of our income. And I would say, yes, that's your gross income. And then we're not holding enough of it in an environment where we have control and accessibility. And this is why Americans feel financial pressure. If they go 1 month without income, or if you're in a commission-only environment, your business doesn't do enough sales, the stock market doesn't go up, the deal didn't pay out, whatever it is, you start to feel serious pressure in your financial life in about 30 days. And so one of the greatest things you can do to toughen yourself up is to get an adequate amount of savings of your income, and that should couple to how many days of liquidity are you holding. We would recommend getting up to 3 months, 6 months of reserves minimum. Some of the best investors I get to work with that are unbelievable at making money and investing are carrying 5,000 days of liquidity, which is an unbelievable amount. And when you ask them, like, why do you carry so much cash? The answer is because they experienced events 2008. I've got scars on my back from 2008 that I will never go through that again, right? So part of becoming wealthy and scaling up the tough money levels is you want to stay in those levels. Now, as you progress and you identify, I've got a current net worth, I'm starting on the call today, and I want a target net worth of $3 million. We call these the Factum 5. These are the 5 most important financial questions you're ever going to be asked. If you don't have clarity on these questions, it's going to be nearly impossible for you to reach some of your financial goals. So let me just run through these quickly. Question 1, do you know how much you should be earning in passive income to live the life you've always wanted? This is called a freedom number. Question 2, do you know how much you should be saving to achieve your passive income goal? We just gave you a clue. How much should you be saving? Has to be 10% minimum. Get it as close to 30% as you can. If you're not going to save 10% of your income, the inconvenient truth is you'll never be wealthy, right? There's just no way you'll do it. You don't have the right habits. So my recommendation would be, if you're not going to save 10% of your income, you better be having a really good time spending all of your money, because it doesn't make any sense to be miserable and not spend money, right? And not save money. If you're going to save, you're saving with the intent that you can invest in the future. And if you can't save the right amount, it'll never happen. Now, question 3, do you know how much you should be holding in cash reserves to guarantee your protection and opportunities when events happen? That's called a liquidity number. You'll need your daily burn rate to run that calculation. By the way, everyone on this call will have a different number for question 3. Question 4, we're going to spend a little bit of time there tonight. Do you know if the current environment where you hold your money is maximizing the benefits you deserve? Or did you wake up this morning, log into your Chase Bank app, check your checking and savings account, and you just were so thrilled and excited by what JP Morgan Chase is paying you in a checking account, right? I honestly don't think that's ever happened to not even one single person on this call. Not ever in their lifetime did we check our checking account and be like, wow, thank you, right? Thank you for the 0.03% that's still taxed. There's just, most people don't have a thoughtful criteria on where they save and store cash. We're going to show you an environment tonight that'll literally change your entire financial plan. And last but not least, question 5, how would you rate your current money management habits? And be brutally honest with yourself. I don't have any, they're weak, they're average, they're strong, or can you confidently say, I've got really tough money management habits? That path of money, I got that sequence down. I know where my money is going. We've eliminated low value spending. We're strong savers, and now we're really starting to get intentional with our investing. Now, whatever you answered to these questions, if you answered no to any of those, we have so many tools and resources we want to give you after this call that'll help you with clarity. And, we always ask people, what's the most important question on this page? And we hear it all. Question 1, 3, 5. And really the most important question is right there at the bottom. Like, would you like to know for sure? I think I know what my freedom number is. I think I'm saving enough money. I think I've got it saved in the right environment. You want to know. In order to have tough money, you have to know these things for sure. And we've got I got a copy of our Tough Money workbook here in the recording studio. Whatever Factum agent you're working with will have copies of these. They can get you this workbook because there's pages that'll take you through and videos that'll walk you through how to identify your exact answer for all of these questions. You will be tough financially after going through that. So going back to our path of money, knowing your income, your net worth, and those 5 questions are all part of understanding how money is moving through your life and how to be more efficient with the dollars that are flowing through there. This path of money sequence will simplify everything you're doing in the financial realm. All right, let's talk about wealth building quickly. So this is called our urgent and important matrix. So if you're on the call tonight, I'm going to assume wealth building is important to you. If wealth building was not important to you, you probably are not showing up tonight. But if you accidentally stumbled on this call and you're like, yeah, this wealth building stuff is not important to me, like, permission to just hop off. There's no guidance required. Do not make this a priority. Go focus on other areas of your life. That's the best thing you could do. But I'm assuming this is important to you. That's why you showed up tonight. So the question is this urgent or is it not urgent? So if you're like, yes, I really do want to build wealth, but it's not screaming at me right now, then what do I need? You need more education. Stay on for the call, learn about these 3 ideas, how they can be effective and useful to you. Make sure you get with the agent that invited you tonight, and they will give you a lot of resources and education to keep learning about wealth building. But if you're on the call tonight and you're like, wealth building is important and it's urgent, I need to figure this stuff out because I want to retire myself in the next 5, 10, or 15 years, which I believe every American could do if they have the right wealth team, the right money sequence, and they have that tough money effect. The money game is actually not that complicated, but we were just never educated on some of these principles. At least I was never growing up. They didn't teach it in school. My parents did the best they could with the education they had. And most of us are left to figure it out on ourselves, which is probably a lot of us on this call tonight. So if this is important and urgent, taking action is what you need. So idea number 1, we're going to wrap it there. The answer to that is tough money. You've got to build tough money. And if you don't build the right habits, not only will you probably not reach your financial goals, but you'll never stay up there. If you come into some money, you won't lock it in and you won't stay at that level. It'll be squandered. It's impossible to keep money if we're not prepared for it. Let's shift gears a little bit and let's talk about idea number 2, the problem. How does the world of banking affect my wealth plan? I first saw this well over a decade ago from an orthodontist here in Chandler, Arizona. Multi-millionaire, 65-year-old individual when I met him. And those are the guys that I went to go learn about money because no one my age had money or knew about money. So I couldn't talk to my peers because they weren't doing anything. Most of my buddies in my early 20s were 60-year-old millionaires. I would ask them questions like, what do you wish you would have done? What should I be thinking about now? And it's where I got a lot of my formal education around money. And one of the books that influenced my wealth plan more than anything else is this book right here, Becoming Your Own Banker. Now, this is less than a 100-page read. I'm an average reader. It takes me 2.5 hours. This book is worth millions of dollars. It's not an exaggeration to every person on the call. It will challenge the way you've been taught to think about money. It'll change your paradigm around money forever. I could not believe that this was possible the first time I read this book. And one of the core ideas in this book is what Nelson Nash, who's the author of this, identifies as the problem, that we finance everything in life. And what he means by that statement is you either borrow money and you pay up interest, or if you were like Kyle growing up, I was always taught to pay cash. And the reason I was taught to pay cash is because that's what my parents were taught, and their parents taught them that same money principle. So you either borrow money and you pay up interest, or you pay cash and you give up interest you could have earned. And the issue here is all of these things that we're financing in life are financed by someone else's banking organization. Let me give you a little snapshot right here. So it's called a future value calculator. Basically, if I'm going to go out and spend like $30,000 buying a vehicle today, my parents would say, do not finance that vehicle. Don't you dare pay anyone interest payments. Go ahead and use cash. And it wasn't until I met that orthodontist who said, Kyle, there's still a cost to using your cash. Because when you give that $30,000 to the dealership, that cash is gone not for 5 years or 8 years, it's gone forever. And you're a young kid, that's a long time for you to lose that money. So if you could have earned around a 4% annual interest rate over 30 years, that $30,000 car purchase actually cost me $97,000 to my wealth plan. That's what's called an interest cost. It is very different than an interest payment. And the longer you're alive, the more those decisions compound against you. So let's break this down even further. Hopefully everyone knows this gentleman, Robert Kiyosaki, wrote the #1 best-selling finance book of all time, Rich Dad, Poor Dad. A great follow-up to that is the cash flow quadrant. Now, in this book, we all learned that we can be 4 players in money game. You can be an employee, a self-employed individual, a business owner, or an investor. We all get to pick this stuff. And there may or may not be advantages to selecting one of these players. The fun part is you can become wealthy no matter which player in the money game you get to pick. Now, my parents, from a young age, my dad owned his own business. He's an architect. And so he was always entrepreneurial. I think he put that in me. I'm very grateful for that. So I always lean towards being self-employed, trying to start a business. And I love the idea of investing and turning my money into a business. I've been all 4 of these players at some point in my life. And it wasn't until I was about 25 years old that I met that orthodontist and he said, Kyle, what about the banker? And I'm like, what do you even mean? What does that even mean? I have no idea what you just asked me, right? He said, well, there's a 5th player in the money game. It's called the banker. And the interesting piece is every other player in the money game relies on the banker in their life. You were just never taught that you could actually own this. And the way I would teach everyone on the call tonight about the world of banking is this is what's going on. All of us have been savers, whether we're employees, self-employed individuals, business owners, or investors. We all save money with some type of bank, and we've all been the borrower, whatever player we are in the money game. The savers put money with the bank lends money to the borrowers, which is a lot of times us. We are fueling this center business, this banking business. The borrowers pay back the bank at a high interest rate, and the bank turns around and pays back the saver at a lower interest rate. Now, when I first saw this, if I had to choose, I definitely want to be the person in the middle of this equation. Or is anyone else with me on that? Like once you see this, you're kind of like, they are controlling and touching that money way more than anyone else. And all they did is start up a brick and mortar business, and people brought money to them, and then they lend out money to the same people bringing it in, and they live very well off the flow of this money. Now, here's what's interesting about the world of banking. All of us on the call, whether you are an employee, an investor, a business owner, all of us are trying to get really good at creating new money in our life. I got to get better at selling my product or service. I got to be more important and vital to the company I'm working for. They'll give me a raise. I got to find better investments to create new money in my life. The bankers are obsessed with control. So the question is, well, what if you become the banker? When you become the banker and you also own the center function, you've created essentially what's called a closed economy for your business, for your investments, for your consumer life. And this is one of the greatest principles and strategies of helping you achieve your financial goals, is by controlling more of the money flowing into your life. Now, this world of banking, where does it exist in our path of money? Right there in the liquidity hold category. This is not an investment conversation here. We're talking about controlling money that's moving through your financial life, and most of us do not have a thoughtful process to do that, and it's literally costing us millions of dollars. So I want you to ask yourself this question. This is going to be a very uncomfortable question. This one is going to sting. If you added up all the money you've earned in the last 10 years, think about that. If Brian's on the call and Brian's been making $100,000 every year for the last 10 years, $1 million has flowed through Brian's hands. How much of it could you access and write a check for today? Now, think about that number for you. What do you currently own and control? As a percentage, what could you write a check for? Now, you don't got to give me your answer on the call tonight, but I'm just curious. Put it in the chat. I ask this question to thousands of people every single year all over the country. What do you think the number one answer is as a percentage of the income they brought in? So if we have someone that made $1 million in 10 years, what do you think as a percentage is the largest check they could write for? Is it 10%, 5%, 50%? What do you all think that number is? Okay, Matt says 0.01%. Interesting. Any other guesses? 5%, says Jared. %. All right. Number one answer goes to Jared, is 5%. It does not matter if we're sitting in a room full of 18-year-olds who just entered the real world, or I'm sitting in a room full of 50 and 60-year-olds who have been investing for 30 years of their life. The answer of what they could write a check for today is 5% of their income. Sometimes we see 10. It's very rare to see 20. And the reason this is not because these people are bad business owners or investors. It's because we do not understand the world of banking and how it affects our financial life. So let's talk about why the number one answer across America is 5%. This is called the annual pattern of spending. If we look at how Americans spend money, about 20% of their income will go to some type of automobile purchase. 30% of their income will go towards housing, rent, and mortgage. 45% will go towards living. That's everything else: food, cell phone, travel, you name it. And the average American is saving 5% of their income. Now, here's what bothered me about typical financial planning is I was told at a young age, Kyle, take that 5% you're going to save and let's go put that in a more risky environment so you can get a higher rate of return. Now, when I look at this, if I'm making $100,000 a year and I'm saving $5,000, somebody help me with this math, and I go get a 10% return on that. What is a 10% return on $5,000? $500. Jeff's got it. $500 does not change my life. That sounds awesome when I get to tell my friends I made 10% investing this year. They don't know that number is $500. That doesn't do anything to my life. If you look at the left side of this, what about the 95% of the money? What about the 95% of the $1 million in the next 10 years that's flowing through my life? What if I just got more efficient with that? I would naturally keep more of that money on my side of the equation. And that's actually one of the number one things from keeping people from reaching their financial goals. So let's break this down. If we isolate this to something just like automobile purchases, in the next 5 minutes, I'm going to show you how to keep more than $1 million in your control just by financing your vehicles a slightly different way. Now, we've all been taught that there's two ways to go out and make a large purchase like an automobile. You either save up money and you pay cash, or you borrow money and you finance the vehicle. So let's talk quickly. What are the benefits of paying cash? What I hear all over the country is, I get a better deal because I can negotiate. I own the vehicle. I'm not making any interest payments. Peace of mind. I sleep better. On the flip, what are the benefits of financing a vehicle? You get to keep your cash on hand. You probably get the vehicle sooner. A lot of people that are investing are saying, I don't use my cash to buy a vehicle. if I could finance it at 6% and go make 12% lending money or buying real estate or stock market, whatever they're investing in, I want that arbitrage, right? So then we go, okay, well, what are the costs? The costs of financing or borrowing money are pretty cut and dry, right? There's an amortization schedule they give you. You can literally calculate the interest payments you're making. What are the costs of paying cash? A little bit more difficult to calculate, because as soon as that cash is paid, you lose the ability to earn interest on that forever. And we don't know when our time is up here. A little bit different calculation to calculate. Now, ask yourself this question after all your auto purchases. Think about how many cars you've owned and driven up until this point in your life. Are you at 5, 10, 11, 3? Think of how many cars. I think I'm on my 5th or 6th car at this point. How much money do you still have in your control after owning and driving all of those vehicles? And you all came to the same answer very quickly. It's a big fat 0. Now, the first time I saw this bothered me, because my whole life I've been taught, save up money, pay cash, save up, drain my account to 0, go buy the car cash. And as soon as I start driving that car, what am I doing? I'm saving up money to make the next purchase 5 or 6 years from now, whatever that time frame is. Well, the person who borrowed the money went into debt right away. They make payments back to the institution. As soon as they pay it off, what do? They trade in the car, they get a new one, they repeat the process all over again. Whether you're paying cash or financing, you both end up with $0 in your control. And the reason it's happening, here's the averages for most Americans. Average American is going to drive 13 vehicles in their lifetime, spending roughly $400,000 doing it. That's principal and interest. Does not matter if you pay cash or finance, the numbers will be about the same. And they're going to both end up with $0. Not because they're not good with money, not because their business isn't making enough money or their investments aren't paying off. It's because we do not think about the banking function. We don't think about controlling this money in our life as opposed to just making new money. So, Jeff, Brian, Paul, someone on the team, maybe you can put the link in the chat to our video from the Money Mastery course on IBC and vehicle financing. We have a 10-minute video, one of our most popular educational pieces that we have. We'll put it in the chat for everyone to have. That's our gift to you. We'll show you how to spend the same $400,000 the average American is going to spend, and you're going to end up with well over $1 million in your control, only changing a couple things: where you store and save your money, and your mentality shifting from a business owner, consumer, or investor to a banker's mentality on controlling more money flowing through your life. Thank you, Jeff. So everyone click on that link, save it to your computer. You can watch that after we're done tonight. That video alone is worth a lot of money to everyone on the call, so you'll be glad you showed up tonight. Now, the reason this is happening is because we're in a constant state of interrupting any type of potential growth in our green hold category by using very common environments like checking and savings accounts. The reality is your Chase Bank checking account is not giving you as many benefits to help you create wealth. I'm a big advocate of whole life insurance. I think it is the toughest foundational asset you can own in your wealth plan because it has a series of benefits you will never find in any other singular asset. It'll take you from being an average saver or borrower, and it'll turn you into a wealth creator with everything you're going to do in the future. So let's shift gears again, and we're going to talk about this toughest asset. So we've covered idea number 1 quickly. We talked about idea number 2, the problem, and it is a permanent control issue. Becoming your own banker, learning about the banking function, is about controlling more of the dollars that are already flowing through your life. So if you're trying to get from a target worth of $840,000 to $3 million, if you get better at controlling dollars already flowing through your life, you're already at a huge advantage. That'll automatically push you up the wealth framework. Now, let's jump to idea number 3. We got about 15 minutes or so left, so I'm gonna go through this one fairly quickly. Idea number 3, the toughest asset. What is the foundation of my wealth plan? Let's talk about this. So question 4 on the Factum 5. Do you know if the current environment where you hold your money is maximizing the benefits you deserve? I don't think anyone on the call is going to say, I'm not working that hard for my money, right? I think everyone here is busting their buns to get things done for their family. They want to be the legacy changer, right? The leader in their family. We're all working real hard. We work too hard to get one or two benefits from a commercial bank. You got to start looking in different environments. And the environment in which you hold your cash reserves makes a massively big difference. So let's go back to our path of money. The banking conversation exists right there at the green center, the hold category. And one of the best tools you can use as a banking tool, as a savings environment, is a whole life insurance contract for a number of reasons. And let's dive into what those are. So quick 2-minute lesson on life insurance. There's basically two types of insurance. There's temporary insurance and there's permanent insurance. On the temporary side, this would be term insurance. So you're buying a product that says, I want some death benefit coverage and I need it for the next 20 years, and then the contract's up. Now, 1 to 2% of term insurance policies pay out. That's not necessarily a bad or good thing, but the reason it's so cheap, I'm using quotation marks, cheap, is because it's almost zero risk to the insurance company to sell a product like that. Now, for the price of a few coffees per month to protect your family for $500,000, $1 million, I think people are crazy not to have term insurance. The amount of GoFundMe pages we see, I think could all be solved by people just carrying a little bit of term insurance. Now, on the flip, we have permanent insurance. And the description is pretty much in the name. This is insurance that should be in place permanently for you. And basically the two types of permanent insurance are whole life insurance and universal. Now, with universal, there's a lot of different types. Variable, guaranteed, index universal life. There's a lot of different hybrid products these insurance carriers have built. I would classify anything a universal life as an investment grade vehicle. That belongs in your gold box. You're investing your acceleration. But good old properly structured whole life is the one we're going to focus on tonight. Now, anyone you go talk to about whole life insurance, because this is what they told me 13 years ago when I started buying this stuff. Kyle, don't you dare buy that whole life policy. It's got a low rate of return. It's expensive to own. It's literally the worst investment of all time. Now, if you're taking notes today, I want you to write this down 2 times. Whole life insurance is not an investment. If you take that policy and you put it in your wealth plan as an investment, you will never understand why this thing is so powerful. You'll miss the entire conversation. So after you get off the call tonight and you're with your business partner tomorrow, or your buddy who you talk finance with, or your uncle who knows everything about finances but has zero money of his own, and he says, oh, don't you dare look at that whole life stuff. It's got a low rate of return. It's the worst investment of all time. If you ever hear someone call whole life insurance an investment, you now know they have absolutely no idea what they're talking about because they can't even correctly identify what it is and where it belongs in your wealth plan. So let's talk about this. When I'm buying whole life insurance, where does this exist in my wealth plan? It's kind of in the name. It's called whole life insurance. So I'm going to classify anything I'm buying into 3 categories: short-term, mid-term, and forever assets. So anything I'm going to do short-term could be like a hard money loan. You could be flipping properties. You could buy some bonds, property flips. Anything mid-term would be like residential real estate, tax liens, business investments, CDs. You could put a lot of things in there. When you talk forever assets, things you're going to own 10 to 100 plus years. Apartment buildings, some commercial real estate, mobile home parks, multi-generational business. Whole life insurance exists as a forever asset. So when you look at like returns, risk, and noise, a lot of people are spending so much of their time trying to find a checking or savings account that gives them 0.3% more growth. And they have to rotate through 5 banks over 3 years to find these deals, or they ladder treasuries and CDs. And the return is moderate. It's okay, but it can fluctuate. 10 years ago, you could not find a savings environment that paid you any type of yield or growth. The risk is very low with these assets because they're not investments. This is meant to protect your money. And the noise, I'm going to give it like a 3 or 4, rotating money through checking and savings accounts. Now, when you go to whole life insurance, which is nothing more than a liquid, safe asset, the return you're going to get on life insurance is going to be any other savings environment, and not even by a little bit, it's going to crush it, especially over time. The best part is there's no risk because it's guaranteed, and there's no noise because it's guaranteed. It is so safe, it is so quiet, it does its thing, and it's got one of the greatest yields from a savings environment you will ever find. I'm going to show you a few examples in just a minute. Now, here's a policy I bought 13 years ago. So in this next year, this coming July, I'm going to pay in or save $8,000 in premium into this insurance policy. It's going to grow by $13,000 that very next year, or $1.62, $1.63 for every dollar I'm putting into this thing. There is no bank I could put $1 in that's spitting out $1.63 for me with no risk and no taxes, by the way. Now, this is not a brand new policy, right? This is the first policy I bought after listening to that orthodontist speak. Now, what's cool about this, if I go another 15 years, and the reason I'm using 15 years is I believe everyone on my call could retire themselves and be free in a 5, 10, or 15-year time frame if you have the right wealth team, the right money sequence, and the right assets on your balance sheet. Okay, so in 15 years, I can guarantee you that version of Kyle is making more money. That version of Kyle needs to store money somewhere. Well, if I store it in that same insurance contract, I'm going to save $8,000 again. This time it's going to grow by $24,000, no taxes, or $3.10 for every dollar I'm putting into that thing. If I go another 15 years and I reduce this thing down to the minimum, okay, the minimum premium for this policy is about $210 a month. So these policies we build are very flexible. You can overfund them, you can pay in less. Our team will help you build and strategize around that. If I pay the minimum premium in year 43 of this contract, $2,600, that $2,600 will grow by $36,000, no taxes, or $13.50 for every dollar I put into it. There is no savings environment that I have found that even comes close to this, and that's one of the benefits that I get. Now, let me show you another policy. This is the gentleman that I work with, one of the best investors I've ever known. This guy was buying insurance the exact same time I was 13 years ago. The difference is his policy that he's saving is $90,000 a year of premium or savings. So his policy is literally 11 times bigger than the one that I have. And so he's going to put in $90,000 of savings this year. His policy is going to grow $154,000, no taxes, no risk, or $1.72 for every dollar he puts into this thing. Small policy that I started with, much larger policy that this guy had. Now, the issue is when he saw my education and found our team, he said, I've had one of these for over a decade. No one ever showed me how to use it as a part of my wealth plan. I did not know you could use this stuff to acquire my real estate, which we're going to show you in just a minute. Now, if he goes another 15 years, out to 28, and this guy gets better at making money every single year, so he's got to store it someplace. If he stores another $90,000 in premium or savings, in year 28, his policy will grow by $307,000 that very next year, no taxes, or $3.41. So you got to ask yourself, 5, 10, or 15 years in the future, do you want an environment that's compounding for you like this, or are you going to continue to use checking and savings accounts that'll never compound like this, especially without any taxation? Now, let me show you the two different ways people are using life insurance to acquire assets. Let's start with option one, which is the typical way. Most people are just saving up money in a commercial bank account, getting next to no benefits, and they save up, let's call it $50,000, and then they find an asset that they want to invest in, so they move it out of their hold category and they transfer it to the investment category. Well, when they do that, that money is gone forever. It is now invested into something new, and hopefully you're good at investing money and your investments are kicking off income back into your path of money. This would just create more savings for you. So what do you do with that? you increase the savings in the bank account and you drain it back down to zero and go buy a new asset and create new money. So your gold category, your investment category is probably doing really well, but you keep interrupting any potential wealth that your green hold category could be generating for you. There's an opportunity cost of doing this. So what I started doing is I still use commercial banks, but I also add in whole life insurance as my primary storage of that wealth. So I take money from a bank, I transfer it to an insurance contract, and the reason I do that is because I get a higher rate of return, I get guarantees, I get privacy, I get a death benefit, I get this loan provision, I get a number of benefits that I would never get at a commercial bank. This gives me some serious advantages in the money game. So let's look at how I might use my life insurance now as part of a wealth building plan. So let's go back in time. I'm 37 this year. When I was 30, I was sitting down with a real estate investor client of mine, and I told him, this guy's in his 70s, and he's very wise, and so I like to learn from him. And I said, Steve, I think the real estate market's going to crash. I lived through 2008, and I'm waiting for real estate prices to come down, and then I'm going to go buy some real estate. And he said, Kyle, I don't mean to burst your bubble, but the real estate market's not crashing. In fact, it's about to explode because we have so many people moving into our state. This is during COVID. We had people from California, Washington, Colorado, all over moving to Arizona during COVID. And it drove the prices up here like crazy. So with my limited education and knowledge around real estate investing, I was not looking at real estate properly until I had the right guide on my journey. Now, I went home and I told my wife, I said, Diane, we got to buy a home like right now. So we found this single family home. It was $335,000. We needed $17,000 for the down payment. So I have two options. I could take cash and go pay $17,000 for my down payment, but then I give up the interest on that money forever. So what I did is I went to my insurance policy that I bought years before this from that orthodontist who was teaching me about this. I had $60,000 in one of my insurance contracts. I called up the insurance company. I said, hey, I got 60 grand. I would like a $17,000 loan against the cash value, okay? So you never borrow from insurance, you borrow against it. And because I borrow against it, I'm still earning a guaranteed interest rate on that $60,000. It never goes down. This is a huge competitive edge I have in the wealth game at this time. Now, those of you that are already doing this with life insurance, when you take a policy loan, does the insurance company ask you, what is it for? How are you paying this back? Is there any credit check? Does it show up on any IRS audit, credit report? No. It is the most private, flexible loan you will ever come across in the financial game. And so I take this $17,000 loan from the insurance company. I am going to pay a little bit of interest because I'm using their money. And then I go buy this house with $17,000 using a policy loan. Now, we sold that home 2.5 years later, and we netted $200,000 on the sale of the home. Now, my regret is I did not go out and buy 5 homes during that event. COVID was an event, and it wrecked a lot of people financially, but it also made a lot of people fortunes. Think about that. Someone in the chat, what's the rate of return? $17,000 to buy that home, and we made $200,000. You know, you're pushing a 500% rate of return over 2.5 years. I mean, my gosh, these events happen every 5, 7, 10 years. If you're just prepared with enough cash when these events happen, you can literally create a fortune and retire yourself with one event. So let me show you just the snapshot. So after I sold this home, we took all the additional cash flow from that and we put it into more insurance policies. So now I can keep it and earn interest on it forever. So I'm not going to spend a ton of time here because we're short on time, but if you want to take a picture of this slide, you can go study it. Basically, it's showing like what was the impact on that one investment I made on my wealth plan. Option 1, using a bank account, or option 2, controlling that money forever and then using a policy loan and redirecting it back into my insurance policy, which is basically a banking conversation. Now, that one investment that I pulled back into my policies is going to have a $2 million wealth impact over my lifetime. This is why I'm like, man, if I would have bought 5 of these, and I was trying to create $1 million of net worth, I could have done that in 2.5 years. It's one of those events, and we live and learn, right? We look back and I wish I would have done this. I wish I would have known that. Well, now we do know that these events are going to be happening on a regular basis. So here's what frustrated me about this. I was always taught growing up, save money with a bank, CDs, high yield savings accounts. But after studying some of these banks do not hold their cash reserves with other banks. They keep their cash reserves in life insurance policies. And I really wanted to know why. Bank of America, Wells Fargo, Chase Bank, they own billions and billions of dollars of what's called cash value in something called BOLI, bank-owned life insurance. You can go look all this stuff up. And the reason these banks want to keep a large percentage of their savings or their liquidity in life insurance policies is because they get these 8 benefits on the screen. They get a guaranteed contract that their cash is always liquid and always compounding at a very competitive yield. These policy cash values and death benefits are completely private. There's an income tax-free transfer of wealth. That's the death benefit. They buy these policies on key executives of the bank. Their policies are growing every single month, which creates what's called an improvement to their income statement. And they have this option to use this flexible loan provision like I did to go buy real estate. You will not find a liquid, safe asset to put at your foundation with more benefits than these insurance policies. And once you see this, you'll never be able to unsee it. The banks know this stuff. Massive corporations know this stuff. Extremely wealthy families have been using this stuff for over 100 years. This actually used to be a common place that Americans used to save about 50% of their discretionary income into these types of assets. They're that old. They've been around that long. And part of our mission here in Factum is to get this education back out to middle America. We just don't have environments that are producing any type of real benefit. So I wanted to share a few different client examples. These are real clients that work with us. And you can kind of see like who's buying this stuff. This one at the top, we have adult clients that buy life insurance policies on their young kids. Why? Because they need a place to save money for their kids so their kids have access to cash in the future. So this little guy up here, the 6-year-old, his parents save anywhere from $1,500 a year to $3,000 a year to save into this policy. Now they can do a little bit more than that, and they own and control this policy. There's $23,000 of cash value into this policy on the 6-year-old. It's growing $131 every single month, net of any taxes. And that little 6-year-old has almost $700,000 of permanent life insurance coverage on him. And so why did they do this? Future financial needs. That kid is probably going to need braces, a bike, sports equipment, a first car, down payment on a first house. The parents want to prepare for that now. It's one of the easiest times to get insurance too, is to get insurance on your young kiddos. Let's go to this 35-year-old. This is actually my policy that we saw earlier. My minimum premium commitment is $2,600 a year. I typically pay in $8,000 to $12,000 a year. That's like the most I can do into that policy. That policy a few years ago had $87,000 of cash value, and it's growing $480 every single month net of taxes. I have not found a commercial bank where I could leave close to $100,000 where they're paying me almost $500 a month net of taxes. By the way, we're one of the few teams in the entire country that watches and monitors these policies monthly for our clients. We've taught this to a lot of other insurance agencies. I'm sure you're going to see this more and more often from other insurance agencies. Here's a 36-year-old client right here in the middle. This guy's an investor in Texas. He had $100,000 and like, hey, I want to put that in year one, and then I want to pay like $25,000 a year premium going forward. That's like his comfortable, affordable number. So he built up $187,000 of cash value fairly quickly. And his policy he has grows $1,200 a month net of any taxes. And he's got over $4 million of coverage on the plan we built for him. So he's like, I can wait for better real estate deals when my cash is working that hard for me. Most people that are investing, their source of financial pressure is their cash is doing nothing. So they get antsy and they need to get it moving quickly. Well, when you have an environment where your money's working really hard for you, you can slow down and be a better business owner, a more patient investor, et cetera, et cetera. Here's a young guy. This is a very successful business owner I work with. This guy's got like 12 policies with us. That's like him, his wife, all of his kids, some key business partners. So between those policies, he's paying in anywhere a minimum of like 250,000 a year to like 600 to 700,000. He's got $2.2 million of cash value built up, and his policies are growing $17,000 every single month, net of any taxes. And he's got just under $40 million of death benefit coverage. So this guy's a serial entrepreneur. He can borrow against that $2.2 million. No questions, no credit check. No one can deny him that. And this guy's using this to fund his business and make the investments that he wants to make. Because in his words, he's like, I've earned the right to use my money. Earlier in his journey, he couldn't get any loans from banks. He had no credit history. They wouldn't lend on him. This is too risky. And he's one of the most successful guys that I know. So the cool thing is that 6-year-old, that multi-million-dollar business owner are all maximizing the benefits of where they save and hold cash. So the question I want you to ask yourself is, with where I'm currently holding my money, am I getting all the benefits that I truly deserve? If you have this path of money down and that insurance contract is in place, you are going to have some serious advantages with the money game. And remember, life insurance has nothing to do with investing or accelerating. So most of the time when people are looking at this, their financial pressure comes from, I've got an unpredictable income. I've got months where I make a lot of money. I got months where I don't make any money. Or they might say, I just have excessive spending. It's hard for me to stop spending money. I have too much reliance on credit. I don't carry enough cash reserves. Or I'm uncertain that I'm going to be able to retire. A lot of this is stemmed because of our money management habits, but also the lack of the environment of where we store cash. When you have one of these insurance policies, it's always growing for you, always accessible. It gets easier to save money. It gets easier to hold cash because this thing is working so hard for you. And a lot of the clients we work with who are not interested in transferring that death benefit through like the next generation, there's like a wealth transfer play that we can have another conversation on. You can take this asset you've been funding for a long time and you can actually use this as part of your retirement strategy. Use it to create more income in the distribution or passive income years of your life, something your checking and savings account will just never do. So in conclusion, we covered the 3 main ideas tonight. This is a high-level overview. We need to go a lot deeper on a lot of these topics, but hopefully you learned something new tonight. You got something that was effective and useful for you. Idea number 3, the toughest asset. The answer is whole life insurance. I have not found another asset to put in my wealth plan in the foundation that works as hard for my business or my family than whole life insurance. So what are the next steps? We are not a sales organization. We're an educational company. I would say never run out and go buy life insurance until you're educated on it. Don't implement any type of investing strategy unless you have your criteria down. This is why it's so important to have a team. So the next steps, it's really simple. Book a free session with someone on our team, whoever invited you tonight, get back with them and say, I want to do one of those path of money analyses so I understand where am I at and what are my next best moves. Some of the best moves that we've been able to locate are saving more money, getting it in the right environment, understanding the world of banking. All of those things are control conversations that you are already doing. You're just not benefiting from it. Once you've got that down, the entire conversation is going to change with your Factum Wealth strategist, which is now, how do I leverage these policies to go out and create investments and achieve financial freedom? So last thing I'll leave you with, this is our Powered by Factum model. All of our agents here are running their independent businesses, but they got a lot of tools and resources here in green. So systems and processes, training and coaching, this community we have here at Factum, all of these things are designed to help our clients with better education, better follow-up, better resources, better tools. And this has allowed us to serve a little over 2,300 clients at this point. We just hit over $1 billion in legacy and death benefit plays for the families we serve. And we maintain a 99% renewal rate with our clients. So our clients are very educated. They're very engaged in the content and curriculum that we've created here. We have so many tools, resources, wealth frameworks to give to you. It'll easily worth tens of thousands of dollars to you. So make sure you get back with your Factum agent, one of our wealth strategists, and book a path of money analysis call. So with that, I know we're a few minutes over. I apologize. I do want to take any questions at this point. So if you have to go, I want to be conscious of your time. Get back to those families you love and support. If you want to hop on or stay on for a few more minutes, I'd love to take any questions you have for me. And you can